Welcome to the webinar. We'll get started shortly. Before we begin, here's how to earn CPE credit. Unlike traditional CPE webinars, there are no polling questions or attendance checks during the presentation. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz in the Earmark app. Search for the free Earmark app from the App Store or Google Play Store, or scan the QR code on the screen. Open the app and create an account. Be sure to use a valid email address because we'll email you your CPE certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. If you don't see the quiz yet, don't worry. We'll email you when the quiz is available. Complete the quiz to earn your CPE certificate. If you have questions or need help, email us anytime at support@earmarkcpe.com. Now, on to the webinar. Hello, everyone, and welcome back to Earmark. I'm Blake Oliver, and today I'm joined by my good friend, Michael Lee of Reconciled for how to sell your accounting firm. Michael, welcome to the show.
Thanks for having me on, Blake. Great to see you.
We are recording live on the Earmark Webinars platform, so please do ask your questions. Michael is a wealth of knowledge. As a serial entrepreneur, serial acquirer of accounting firms, I should say, Michael has, well, how many firms have you integrated into Reconciled now?
3 so far.
3. All right. And how have those gone? Have they all been just fantastic successes?
Well, it depends on how you define success, but yeah, they've all been great learning experiences with both challenges, failures, and wins. So it's been great. I'm excited to share more about it.
Yeah. Tell us a little bit about Reconciled. Where are you at now?
So yeah, Reconciled is a national, online bookkeeping and advisory practice. We serve small businesses throughout the U.S. Started about 8 years ago. We got team members throughout the U.S. in about a dozen states. We serve customers in half the states in the country. And then we also have about 10 team members in Argentina as well.
And how is Reconciled different than a traditional accounting firm?
Well, there's probably a lot of different aspects to that, or a lot of ways to answer that question. One is we don't have a central office that we all work from. So we're not based in one local community. We're not serving one major metro. All of our staff works from home or from a satellite office, and they work remotely, serving customers throughout the U.S. So we basically see none of our customers in person. All of our services are done online and remotely. And we also are charging on a fixed monthly fee pricing model. So although that is not necessarily a new phenomenon in our industry, compared to the percentage of accounting firms doing it in the country or in the world, we're still in the small percentage of firms that are billing on a SaaS revenue model or a recurring revenue model. So that makes some of the intangibles unique. We also are very focused on our brand, Reconciled as a brand. You'll notice that the company is not named Michael Lee Consulting or Lee CPA Services or Tax Services. So we're really focused on the brand, where I really want myself, my face, my name to be removed from the brand identity. And I really want it focused on who is Reconciled and what do you get when you come to work with Reconciled as a customer.
Jonathan in the live stream says, watched your video on how to buy an accounting firm last night. Loved it. If you haven't heard that episode or watched that video on YouTube, go check it out. Just search for how to buy an accounting firm with Michael Lee. And wait, is this one how to buy? This one's how to sell. Yeah. How to buy was the last episode. So Michael talks about all of the everything you need to know as a buyer. And now he's going to talk about everything you need to know as a seller, having been a buyer. So eager to get into that with you, Michael. So let's talk about timing. When is the right time to sell your accounting firm? What do you need to consider?
Yeah, I think there's a lot of different ways to answer that question. And it really depends on the firm owner and when they're ready to sell. Now, I'm going to make first the conversation really about, and most of this conversation is going to be very focused on a single firm owner. But this also can pertain to a firm owned by multiple partners, because I've actually purchased both types. I've purchased firms that were owned by a single owner, and I've purchased firms owned by multiple people, where I bought the whole firm from those partners. But really, it's a matter of, is the firm ready to sell, and do you believe that you're ready to retire? For most firm owners in our industry, it's about retirement and when they're ready to exit the industry, the accounting industry. And I would recommend for most sellers is, if you're going to sell your firm, sell it and begin the conversation several years in advance, and make sure that you're actually ready to exit the industry. There are firm owners that want to sell and they're not ready to exit the industry. They're actually going to continue in the industry in some capacity or another. And I'll tell you, that limits your buyer pool. Most buyers don't want to buy from a firm owner that's going to stay in the industry. And there's a variety of reasons for that. One of them is they're going to be afraid or assume that you'll go after the same customer base that they just purchased from you. And so why would you sell your firm as an accounting firm owner if you're going to continue to do accounting work? That's a strange idea to a buyer. So if you don't want to limit your buying pool, you definitely want to be able to sell or prepare to sell when you're ready to exit the actual industry. Another key sign of an indicator of wanting to sell is there might be market timing, right? The market might be a ripe time to sell at the highest value. So there's certain times in the market where accounting firms are very attractive to purchase. I would say right now it's a very attractive time to purchase, because we're not yet at the height of all of the accounting firm owners selling their firms yet. So we're not at the largest peak yet. I would say that peak is going to be in another 5 to 10 years, where the majority or the largest number of accounting firms are going to be sold. So it's a very attractive time to sell, where you can maximize valuation. So that's another. And I'd say the last one is, you're at a place in life where you're tired, or you're not showing up every day as your best self as a leader. You're not willing to grow the firm anymore, or you just don't want to do accounting work anymore. That's probably a sign that you're ready to sell the firm. But I would encourage you, before you get to that spot, if you're an accounting firm owner out there, before you get to the place where you're tired and you're willing to sell your firm for anything, I would begin the conversation a couple years before that. And I know that's hard to tell, when am I going to be tired? Because anything can happen and get you that spot. But it's good to start early in the conversation.
Right. It's like when you're selling your house, it's better to sell your house when you don't really, really need to do it.
Right.
When you have options. Sell it before you're under contract on another one, right?
Right. Exactly. Yeah. And same with the firm is, you don't want to sell it when you're in the middle of tax season and you're tired and you're upset at customers and you're upset at your staff, or you don't want to sell it then, because you're desperate and you'll make decisions in desperation. You want to sell it when you're actually the happiest with your firm. And you want to sell it when you know the value of the firm, it's at its peak, and you can get the best dollar. You want to sell it when people are really attracted to the firm right now. You don't want to sell it when it can barely function and staff are leaving and customers are leaving. That's a bad time to be selling your firm.
It's a bad time because you're going to get a low valuation, because your people are unhappy, your clients are unhappy. It gives a bad vibe, for lack of a better term, to the buyer.
Yeah, and I also sell too. I would not wait until the last possible age that you think you could work. That would honestly be also a bad time, because likely a buyer is going to ask you to at least stay on for 6 months minimum, if not a year or two tax seasons. If you're a tax accountant, they're likely going to ask you to go through a couple of tax seasons just to help retain the clients. And if you're in your final tax season and then you put this firm for sale, you're not going to want to be involved with that process. So I would not wait until the last final year that you want to do a final tax year. I would do 2-3 seasons before that, put your firm up for sale and begin having the conversations.
Robin says, love that. Sell when you are happiest. Counterintuitive, but it makes a lot of sense the way you've explained it, Michael. Buy low and sell high. Well, let's talk about the value. How do we, in advance, make sure that we get the most value for our firm? Let's say, well, ideally, like how far ahead should I start planning on this, Michael? Like at
Yeah,
least a few years, right?
I'd say a couple of years at least, and I
Yeah.
would begin talking to brokers if you're wanting a broker to represent you. And frankly, for most firm owners, I would highly recommend that a broker represents the firm owner. And the reason why is it's a full-time job to sell. Just like it's a full-time job to buy a firm,
Yeah.
it's a full-time job to sell. And remember, you still got to run the practice while you're selling. You can't let the practice fall apart in the midst of the selling. Just like having a house, you can't let the maintenance stop. You can't just stop mowing the lawn and taking care of the yard and taking care of the pool because you're in contract. You got to keep it going. Otherwise, the pool will be green colored and the grass will be growing, and the buyers will come by and go, "Ooh, what happened to the house? I don't want that house anymore." So you got to keep it going. So I recommend that for most firm owners that they get a broker or at least some advisors involved that can be a part of prospecting potential buyers. And then I would be talking to potential buyers a couple of years in advance. Even if you're going to sell in a year or two, talk to buyers and say, "Hey, I'm going to be putting up for sale, and I want you to know that, and I want to be in conversation with you to talk about what will you find attractive about the firm? What do you want the firm to be in the next couple of years in order for you to want to buy it?" And so you also have to be ready for some transformation in that time. But again, a couple years in advance so that you can understand what the
Mm.
buyers out there are going to want from your firm.
How do you get in touch with those buyers? How do you find those buyers? I imagine if it's a few years before you're going to sell, like would a broker be interested in connecting you with buyers if it's that far out in the future?
Oh, totally.
Okay.
The best brokers would love to talk to you early. One is because then they can advise you on what the market's looking like. A broker might tell you, "Hey, actually don't wait 2 years. Let's start now because the highest prices I'm seeing are happening right now. And you've got a 6-month window or a 1-year window. Let's get you prepped right now." A broker may also be able to advise you, "Hey, what you thought was valuable with your firm, you're going to have to change." Or here's some changes on service line or on software that all of the buyers we see today are asking for from our sellers. So they may be asking you to implement a specific workflow tool or a specific tax software. Maybe you're on an old tax software that's not cloud-based or cloud hosted yet. Maybe they're going to ask you to transition to that over the next 2 tax seasons. Or maybe they're going to ask you to leave QuickBooks Desktop hosted and go to QuickBooks Online. Maybe they're asking you to shift from hourly billing, time and material billing. The amount of firms still doing that, it's still 90+% of the market is time and
Yeah.
material billing, right? Well, the broker, if they're smart, is going to say, "Hey, can you start converting your customers in the next 2 years to a recurring revenue model? I'm going to be able to sell your firm for a higher value." So talking to the broker early is great. On the
Mm.
buyer side, there's a lot of ways to start that process. One is if you're an introvert, right, and you haven't been outreaching to fellow peers in the industry, we'll start going to the local CPA society meetings. Reach out to the AICPA if you're a member. Go to the Engage conference. Go to the Digital CPA conference. Go to some of the bigger conferences that QuickBooks puts on or Xero puts on, and start meeting other firm owners. Contact your local regional big firm CPA firm player. See who's out there in your market buying. Ask the brokers who's buying in this market right now. There's actually a lot of buyers right now, both current accounting firm owners and non-accounting firm owners
Oh, yeah.
that are buying right now. So reach out.
So that's a really interesting point is there are a lot of non-accountants, non-CPAs, such as yourself, getting
Yeah.
into the accounting services business, turning it into an industry. And how do we find those people? I was talking with Eric Freint of Your Part-Time Controller. They're a top 100 firm, and they just sold to private equity. He owned like 100% of the firm.
Yeah.
A top 100 firm, right? He sold to private equity. And he was telling me that, the offers they were getting from the CPA firms in the space of similar size were just terrible compared to what
Yeah.
he was getting from private equity.
Yeah.
So, like you're saying, go to the societies and meet the other CPA firms, but maybe that's not the best option for selling your firm. How do you
Well,
find the other
for
buyers?
most firm owners, they're not going to be at a size where private equity or outside private capital, outside of the accounting industry, is going to be attractive for a lot of people.
Hmm.
So there's probably two buckets. One is if you have a firm, a small firm between $500,000 to $2 million a year in revenue, and you're doing decent margins, decent EBITDA on that. The buying pool is going to be other firm owners, other accountants that want to leave the practice they're working at to buy their first practice. And then there's also non-accountants, somebody like non-CPA, somebody like myself, or an MBA graduate from Harvard, Stanford, think of the MBA program, or somebody in corporate that's thinking about buying their first accounting practice. Now you ask them the question. Now you might ask the question: why would somebody that's non-accountant want to buy an accounting practice?
Oh, I know.
Well, yeah. There's
They're very
actually
profitable.
highly profitable. The
Yeah.
businesses are highly profitable. It's considered one of the most profitable businesses in the U.S. And so the buying market is going to be pooled around individuals, generally buyers that are going to be owner operators of the business.
Got it.
Once you get to 5 million and above, and especially with somebody like your part-time controller or other brands that have a strong brand in the market and they're growing rapidly and they have a strong presence nationally, you're going to then be a potential candidate for a larger strategic buyer or a PE group, right? A financing group. And there are dozens of PE groups right now looking for their first accounting firm to buy. But generally, the low end criteria is going to be around 5 million minimum in revenue before they even talk to you, but ideally 10 million in revenue and usually 2 million in EBITDA or higher before they even talk to you. And that's frankly not most firms. Most firms are fairly small, hovering around really under $1 million a year in revenue. So they're likely going to have to sell to somebody else that's a practitioner in the space.
So you mentioned two ways to increase the value of your firm. One was adopting modern technology, and the other was adopting fixed fee, recurring billing and moving away from hourly.
Right.
Of those two, which one do you think is the most important?
I think the revenue model is the biggest importance, mainly because getting the transition of your customer base from time and material billing to recurring revenue model, that's actually some hard work. You have a customer base that's so used to getting billed to you hourly, and that means that you as a practitioner haven't sold them the reasons why and the value of transitioning to a recurring revenue model. The reality is the market likes recurring revenue contracts, especially recurring revenue contracts that have a term like 1 year, 2 years, or 3 years. It's synonymous to software agreements where they have recurring revenue terms or enterprise software agreements. So that's actually a hard work. Technology transformation, a lot of younger owners and a lot of new buyers are willing to go through the headache of a technology transformation instead of the recurring revenue pricing, right? Because a technology transformation, a lot of your customers actually don't see any of that
Right.
behind the scenes, and you never have to get a customer's permission to do technology transformation. You say, we're updating our own internal systems, we're doing movements. And so it's rarely that you have to ask a customer. They're going to be like, oh yeah, that sounds great. I've actually wanted you to update the technology for a long time. That's an easier transformation to occur than getting most of your customers to go, hey, will you sign this agreement and commit to paying me monthly for the next year, 2 years, 3 years? And that's a lot of work that a buyer would like to see done before they buy.
Stephanie on the live stream said, what kind of impact does the contract length have on enterprise value for fixed fee firms? For example, 6 months versus 1 year, etc.
Yeah, that's a great question, Stephanie. I would argue that it's too early to tell at a mass scale. I would say that you're likely going to move your firm value up by a tenth of a point or even 20th of or 2/10 of a point, mainly because the amount of firms that are still at time and material is so massive that most of the firms you're going to see on the market are going to be in time and material phase. So the bigger question is, what is the pricing difference between a firm billing time and material versus fixed monthly fee. That
Yes.
is what you're going to see the majority of the time.
What is it?
And I would say you're going to move from, I've seen firms at time and material sell for 0.5 revenue valuation, half of revenue valuation, and then jump up to 1.25 or 1.5 in revenue
Wow.
valuation. So it's
So,
going to be it's a massive swing. But imagine even firms doing 0.8. I've bought firms at 0.8 to 1 times.
yeah.
And I will tell you, at fixed monthly fee, I'm willing to pay 1.25 to 1.5 times revenue because I've already done that work, right?
Okay.
So
I,
it's a big
that's a
jump.
lot.
Yeah,
That is the financial reason to make this change is
yeah,
you could get 80 cents on the dollar for your firm, or you could get a buck 25 to a buck
yeah.
50 on the dollar for your firm. And we're talking top line revenue there. And
Correct,
all
correct.
you have to do is change to a recurring revenue model,
Yeah. Well, we say that it sounds easy,
right?
except for firm owners, it's a very difficult transition for most firm owners because they never thought that way. They haven't had the education around it.
Yep.
And all of their systems is built around tracking time and expenses
And
and then
billing for the
billing it
time. Yeah.
after the fact, right?
Yeah.
And then hoping that the customer pays and hoping that the customer doesn't have any disagreements with that time and material billing. So all the systems are built around that. Even the tools that they're paying subscription. It's funny, the tools they're paying subscriptions for the systems to track time isn't on a subscription basis, and yet it hasn't clicked for them that
Yeah.
they could go out and do subscription
Yeah. Yeah.
basis billing
You're
themselves. Yeah,
not paying for the software based on the number of hours that you bill to clients.
right,
That'd be an interesting strategy.
right.
Any other surprising insights? Anything else you've learned from buying, selling, that about valuation with firms?
So there's two things. One is most firm owners have a misunderstanding of what their firm is actually valued at today in the market. What is the market willing to buy them? So that's why talking to a broker, talking to other people who have sold and have talked to buyers and have sold their firm, it's going to help you level set what is your firm actually valued at. And secondly, and surprisingly, most firm owners, the number one reason they're selling their firm, the one criteria is not the firm valuation. So I would tell you that for most of the people I bought from, they did not put valuation as the top reason. It was probably the third or fourth or fifth reason. The top reasons for them were how you're going to treat my staff, what's the opportunity for them for growth, for a job, for longevity, how are you going to onboard my clients, what are how are you going to serve those clients? Because like I said in the beginning, most firms are based in a local community.
Mm,
They're serving community members. So they're serving people they know at their church or religious place. They know from their local, school, the nonprofit they've served at. They go shop or purchase product services from those customers. They golf with them. They know them from the country club or from the chamber. So you, as the buyer, are now, to the seller's perception, are going to impact the reputation of that seller in their local community. So that's actually in the top is the employee, how you're going to treat the employees, how you can treat the customers, and then what does a transition plan look like for the seller? Are they going to get, how much cash are they going to get up front? How long is the seller going to have to be involved with the firm in the transition? And then what is the seller going to have to do to either earn or ensure that they get paid the remaining consideration of the purchase price that you offered? So those were actually the majority, or the criteria that was the most important. The valuation was actually not the most important in the
mm.
process.
And I want to dig in more to those other factors with you as we go through this. Kathy says, we are currently on fixed monthly fee for the majority of our clients and have been for a long time, but our contracts aren't for specific timeframes. Would that affect it?
So for Kathy's sake, and for anybody that has a similar situation like Kathy, where you have basically a
Month to month?
monthly recurring contract, it recurs every month, but it's still monthly. A customer can cancel at any time. Then what's really going to be important is your churn rate, right? Or your retention rate. So What a buyer is going to look at is how often do your customers leave you? How often are they leaving you from the moment they sign up? How long are they staying with you?
Mm-hmm.
And how are you able to increase their pricing over the time with you? Now, those three things matter, right? They matter to a sophisticated buyer. One is how fast does a customer leave you? That means are customers happy with you in general, especially if you're in the bookkeeping or cash space and you're doing fixed monthly fees. How fast are they leaving you? Are they signing up for just the first 6 months? Because that means they're probably like a cleanup client, likely, or they're doing a one-time tax return or tax planning. Retention is how long are they staying with you, or how likely are you going to keep them for how long? So you want that to be really high, and you want the
Right.
churn rate to be really low, right? And then you want upsells. How likely are you going to increase your average over time? That means you can increase or get the same customer to buy more services from you. That is a sign that you're the type of firm that obviously is good at selling the value
Mm.
and getting your customers to buy more.
And I would encourage everyone to get a basic familiarity with SaaS metrics, software as a service metrics. Michael mentioned one of the really critical ones, which is churn. Um, there's also cost to acquire a customer. There's lifetime value of a customer. And you can actually compute the lifetime value of a customer if you know your average contract value, you know what your typical customer pays you, and you know your churn rate. So those two things, right? What does the average customer pay you every month? And what is your churn rate? Divide that by your churn rate, and you get your average customer lifetime value. And that is really useful information for a buyer, because even if you're month to month, they can say, well, based on the churn rate, these customers are sticking with this firm for 10 years.
Yeah. Yeah,
You can
exactly.
project it out, right? If you lose 1% of your customers every month, then we know that a typical customer will stay with you for 100 months. That's like, what, 8 years?
Yeah, it's amazing.
Yeah.
That's an amazing stat, right? And that's even hard in software, right? Software
Yeah.
churn rates and retention rates. So yeah, as Blake said, get to know those. Another
Yeah.
thing around firm valuation, it's really important for a buyer to know how much of the billings, how much of the revenue of your firm is being billed by your staff versus you as the owner. And one of the dirty little secrets about accounting firms is the reason why accounting firms have such high net income or net margins is because the firm owner is billing so much themselves as an owner.
Yeah.
So what happens when you leave? If the buyer themselves can't either do the billings themselves or replace you, all your net income is basically gone. If you think about how
Yeah,
much you contribute to the
it
bottom line
becomes
as an
cost of
owner.
labor at the end. You got to hire somebody to do it.
Exactly.
Yeah.
So the attractiveness as a firm of being higher valued is, has the owner figured out how to have all the staff do most or all of the work, and the owner themselves is just doing sales and running the firm? That makes your firm very attractive to a bigger buying pool, because now you don't have to sell it to CPA. You're not relying on a CPA making sure that they sign off on every tax return or sign off on every audit. You can get an owner that just has good business acumen and good selling principles, selling
Yep.
practices, and they can then come and run your practice and continue to grow it.
Yeah.
That opens up a bigger buying pool.
Benjamin asks, as a seller of a firm, how can I get comfortable around selling to a buyer, perhaps someone like yourself, who doesn't have a CPA/accounting experience? What did you do to convince them that you were a good buyer?
That's a great question, Benjamin. So for myself, for example, I actually have an accounting background. I've done accounting inside companies, but I never worked or ran or did audit or tax inside public accounting firm, or never done really tax preparation myself. So one, to get a buyer for you to be a seller, to be comfortable with buyers, one is, what's the track record of the buyer? Has the buyer started a business before? Have they run businesses before? What was their experience in corporate? What is the motivation around the buyer to buy your firm? What's their plan to, if you're a CPA, you do a lot of billing, what's their plan to replace you? Do they potentially have a candidate or two that they already have set aside that they're going to hire and bring into the practice? Do they have a potential business partner that's a CPA? So that's all really important. For me, obviously, I had built Reconciled for 5 years before I even started talking to the first firms I was going to buy. So that was really, really helpful. And they, obviously of the sellers were able to see the brand I was able to buy, so, or to build in order to propose. Secondly, I came to the table with financing. So as a seller, if your buyer comes to the table with financing, at the end of the day, like when you sign a letter of intent and you're giving a buyer a period of time to bring the funds in for purchase, it's important for the seller to know, hey, what's the likelihood of this buyer to close? And so if a good buyer is going to have the right financing at the table and the right process to get you from signing the LOI to the close date, right? Just like when selling a house, you want to know the person you're selling a house to. What's the likelihood of them getting the mortgage approved and getting you to close? That's really important, because you could lose another 60 to 90 days and start all over if that buyer isn't successful. So that's really, really important.
Look for a record of success. That's why once you're in the housing market, it's a lot easier to buy a house.
Yes. Exactly.
Let's talk about protecting your clients during the transition. And we have a great question from Greg to get us there. Greg asks, is there a standard client attrition rate when firm ownership changes? Do you have a benchmark, Michael?
That's a great question. I don't believe that there's I haven't seen a market out there where there's a standard rate. I don't see the studies out there or a science around it. But I will tell you that I'm not surprised, and I expect and I plan for somewhere between 5 to 10% of the client numbers, that the quantity of the clients that go away. And there's a lot of reasons why, but one is, for us, when we buy a firm, our pricing is generally higher. Our average pricing is generally higher than the firms we buy, because we've spent time iterating on pricing, continuing to increase it over time. So we expect that there are clients of the firms we buy where they're getting what they call the friends and family discount, and they've gotten that for years. It's the family member or the friend that said, "Hey, we'll do your tax returns, we'll do your bookkeeping services, but we're going to discount it heavily." Well, that can only last for so long, and the reality is, when we come into the picture, they're likely going to leave because we're not a friend or family of them, and secondly, we're going to raise their prices fairly quickly over that time period. So we expect that. Now, revenue wise, that's client attrition in numbers, but the revenue I expect to stay the same or increase because of our pricing increases, and because we're actually going to start implementing the value of selling value, right? The practice of selling value, which is the firms we buy from. They're almost all of them have done time and material billing. So the fact that we switch to selling value now and converting them to fixed monthly fee actually increases the revenue over time. And there's a lot of reasons for that, and I could talk about that if somebody's interested. But I do expect generally 5 to 10% of the client base numbers to go away, but the revenue to stay the same or go up.
What is your goal in terms of revenue?
In regards to when I buy a firm?
Yeah, increasing it, right? So you said you expect clients to decrease 5 to 10%.
Yeah.
What do you aim to increase revenue by?
I want to try to shoot for, in the first year, to increase revenue at least by 10%. So, and that's while losing customers in quantity.
Yep.
Because the customers that do stay, the 90% that do stay, you get them on fixed monthly fee and you sell them higher value. So therefore, you're increasing their rates, and that defaults into at least a 10% increase overall in revenue in the first year.
And what kind of services are you adding to increase the value for them, so they're willing to bear this higher price?
Oftentimes, there's a technology upgrade. So you're doing a technology upgrade from something like QuickBooks Desktop hosted to QuickBooks Online. So you're selling the value of real-time reporting, right, and access for the client to their financial reports in real time. The other thing is advisory services. A lot of the firms we buy, they're not doing true advisory services on a consistent monthly basis. So now we're going to sell that as a package on top. We're also going to add tax return services if they don't receive those from the firm yet, and also HR services as well. So those are all things that we can add. Yeah.
Yeah, that's unusual. HR services. Tell us more about that.
Yeah, HR services would be at the administrative level. So think of creating and administering an employee manual, creating an employee onboarding process, helping with employee screenings, employee offboarding process, helping identify the difference between a employee and a contractor and defining that for the customer, creating a plan that financially that aligns with their growth plan. So they're all things around HR.
That's interesting because those are things that we kind of do one-off. We may
Yeah.
advise reluctantly on that as CPAs or firm owners, and you formalized it into an offering.
Right.
Back to valuation. I knew that valuation would be a popular topic, which it always is. Stephanie wants to know, what is the average revenue multiple when valuing a firm? Michael mentioned 0.8 to 1.5 times. Is that standard? Are there niches that are more attractive or higher value than others? For example, cash practices serving tech startups versus construction companies. So
Right.
there's kind of multiple questions in there. So I'll let you tackle that.
So the remember, as I've said multiple times, most of the industry is billing on time and material basis. So the average of most of the industry valuation is lower because of that reality. And so most firms, the average right now, if you look at any website, any broker website, and if you are in the practice buying firms, most firms are selling around 1 times revenue. And I said that gives or take a few tenths of a point based on variations of reasons. Also, the longevity of how long it gets to paid out. So one of the things that a seller doesn't realize is, okay, you can probably get a higher valuation from a buyer, but that buyer likely will string out the payment term of when you're going to get that paid out so that you can earn that out over time to prove the value the firm stays to and is connected to that higher multiple. So one of the things that I've done in my negotiations is, and buyers will do in negotiations is, if I want to pay out a seller faster, right? If a seller says, "Hey, look, I want more cash up front and I want to get paid out sooner or faster," well, you can offer a lower valuation in order to get the payout done faster. Let's say 0.8, 0.7, 0.6. I've seen 0.5 out there where it's like, okay, seller wants to sell and they want out quick. Okay, well, the buyer's taking a lot of risk getting you out quickly, not having you involved as long. I'm going to pay you more cash up front, and I'm going to pay you the rest faster within 12 months, but you're going to lower the valuation. If you want a higher valuation, like 1.5, even 2 times, and I've heard of the market out there, firms selling for 2 times, they're getting that paid out over 4, 5, 6 years. So imagine as a seller, you having to be involved with the buyer's business for a matter of 4 or 5 years or 6 years. Well, okay, yeah, you might get that higher valuation, but the reality is things might change with the buyer's business over that time frame. So,
when I sold my firm, my term was 4 years. And I got to say that when I got to like year 3, I was like sitting there praying every month that the check came.
Yeah,
because I
exactly.
was away from the business. I had no idea at that point, and I was really just relying on the buyers. I mean, obviously, there's like legal mechanisms to make sure you get paid, but if at that point, it would have cost me more to get the money legally, right? I had to trust them.
Yeah,
and luckily it worked out, but yeah.
And so it's not. It really. I think sellers need to realize this. It should not be based on just what's the highest value I can get, because value and terms are all negotiable, right? And so, would you rather? I tell sellers, look, assume whatever cash you're going to get up front, you got to be happy with, because there's a risk. There's always a risk that you may not get the remaining amount later on, the remaining amount of your consideration. And will you really take the legal recourses to go after those? Because that also think about it, the buyer that just bought you, it puts them at legal risk if you go. And if they have financing involved and you sue, well, the buyer's financing actually is seniority to you in almost every situation. So you put them at legal risk of them having to report to their lender, report to their equity partners, and now you've got this big battle that you probably aren't willing to fight, and the cost is so high to win it that it's likely going to cost the same than what you're going to get paid anyway. So you got to think about the reality of valuation should not be the only top reason you go after selling your firm. There's got to be other reasons, and negotiate what you can in the beginning and willing to compromise on some things in order to get what you want in the beginning.
What's your favorite earnout structure? How long do you like to pay out the seller?
Yeah. My personal favorite is getting the seller out as soon as possible. And the reason why is most sellers, once they've received their large chunk in the beginning, let's call it 40%, 30%, 50%, whatever it is, large chunk of cash at close, their incentive to want to make the deal work over the next period of time continues to go lower as time goes on, because they got
Human
money in the bank
nature.
now.
Yeah.
They got paid now, and of course they are compromising being paid the rest over time. But the reality is there's money in their bank and they're not hurting anymore. They're not financially, and the firm's gone out of their control.
Right.
So they're not having to run the day to day. They're really having to help you with transition. Now, thankfully, most of the sellers I've bought from have been really cooperative and have been great, and they want me to see me successful. But that's not going to necessarily be the case with every seller that you buy from. So my preference is, how do I get the seller out within a year? And then as we go throughout that year, how do I actually negotiate to get them out sooner than that? How do I give them an opportunity to get out sooner than that? Because remember, everything's negotiable, even during the period of time that they're involved with your firm.
So you're
So
aiming for a year or less.
yeah, a year or less. Now, other buyers are going to be different. They might want you involved way longer than that. And some sellers they might be young. They may want to be involved in much longer because they're like, hey, I got nothing else to do. I'll happily be involved with you for a long time. So it's going to be different. There's no standard there. But for me, it's a year or less. That's actually my preference.
Now, you mentioned this at the beginning, the idea of staying in the industry or profession versus leaving it. You are
Yeah.
looking for sellers who want to exit, retire, do something else, get out of accounting.
Yes.
And that's because you don't want them competing with you
Right.
later,
Right.
turning around and starting a new firm and taking back the clients. And that happens actually all too often, unfortunately. I've witnessed that happen in my own peer group recently. So, and it does not end well for anyone. So let's talk about these non-compete agreements. How do you approach them with your sellers when you are buying?
Well, yeah, non-compete agreements you want to have for a length of time that is reasonable. And also, the reality is different states have different rules around what is reasonable and what is enforceable, right? So you want to make sure that you have a non-compete agreement and a non-solicit agreement, right? That's actually the key, is a non-solicit agreement, which is more enforceable in most states than a non-compete agreement.
And that
So
means I'm
yeah,
not going to go and solicit the clients that you have bought. I'm not
correct.
going to go talk to them and say, hey, come to my new firm.
Correct, right, and a non-solicit agreement can contain all types of solicitation, right? So, for example, a non-solicitation agreement would say you will not solicit for any reason the employees, customers, or vendors of this firm that you're
Oh, yeah,
selling to.
that's important.
So that's really important. So why is that important? Well, if you have a firm you're selling and you have contractors that are doing tax work for you or advisory for you, they're technically not your employees. So if you don't lay out a non-solicit and you have a lot of different contractors that are vendors for the firm you're buying, well, technically speaking, the seller can go and use them for other services for another firm or another business that they have. So you want to be able to say to the seller, hey, I want to use all of the relationships to my benefit because I'm buying your firm. There, and when you're selling a firm, there's no hard assets generally. It's not like I'm buying a server or mainframe or IP. The IP is the relationships that they've
The
built
people.
with
Yeah.
the people, right? And that includes vendors and customers and employees. So the non-solicit says you can't solicit them for any reason at all. And a non-solicit could go as far as saying you can't solicit them even if I don't decide to have a relationship with them after I buy your firm, right? So because you could choose to let go of all the employees, or all those employees could decide I don't want to come work for you, right? There's also that risk. They could say I don't want to come work for you, or the vendors can say I don't want to have a relationship with you, or the customers can too. Well, you don't want them then going back to the seller and saying, well, I'm just going to come work for you and start another firm, or work with you, start a new thing. So that's also part of a non-solicit. That's actually the more important piece, is a non-solicit agreement.
What are the top mistakes that you see when people go to sell their practice? As a buyer, I imagine you look at a lot of firms.
Yeah.
How many firms did you look at to buy the 3 that you bought?
We probably looked at least a dozen or more.
Okay.
Right. And I probably had at least 50 prospecting conversations with firm owners. So I've talked to a lot of firm owners over the past 4 years. Yeah.
So I imagine during that due diligence, items came up that scared you away.
Yeah.
What are those red flags?
Yeah. So the top mistakes for the sellers is, one, you don't want to be involved with the firm after the sale. So that's a big one. Like, you're at your last tax season, you're not going to do anything anymore. You're done. That's a big red flag for me. Because how do I then get you involved in transition? How do I know that you are going to really help with the customer transition? So that's
Right.
that's a big one. Another one is, you as the seller are doing most of the billings. You haven't built a staff around you to do work and to hold a relationship with the customers. So my risk as a buyer is, well, if you leave even in a year, these customers are loyal to you. You have all the relationship right now. How am I going to get them to want to work with me? So it's a big red flag for me as well. So and then the third is, misrepresenting the actual size and the actual makeup of your practice.
Yeah.
So if you're going to list your practice, make sure what you list actually represents, with 95% or 100% accuracy, what the details say, right? So if you say, hey, we're this percentage of tax, this percentage of bookkeeping or advisory, make sure the details support that. If you say we have 100% of our customers on contracts, make sure that's real, because due diligence is going to find out, a buyer with due diligence is going to find out if you only have 50% of your customers on contract.
Has that happened to you?
Oh yeah, that's happened plenty of times. And then you go, hey, this isn't going to work, because there's no contracts for me to buy in this process. No customers for me to buy. Yeah.
What about the, like, personal expenses of the owner that are being run through the business?
Yes, that's really, really important to understand. Now, most for business owners, obviously, because accountants are tax professionals, they know the appropriate personal expenses to run through the business and why. Now, one of the things you're going to have to do in your presentation, for the seller, the mistake they do is they present their financials and they don't remember to add back all of the personal expenses they run through the business. Now, remember, when you sell your firm, that's all going to go away. So your car lease that you have, the cell phone, the life insurance you're paying for, your own medical expenses, the kids or spouse that you have running through your business, that's all going to go away. So don't present the firm's financials as if those are going to stay. That's only going to lower the value of your firm, because the buyer's going to think, oh, why is your net income so low? Because you maximized having the least amount of taxes. You actually want to add all that back and show a high net income to the buyer, so they see how attractive your business is. So a seller working with a good broker is going to get that education. But I've seen sellers forget to do that. And I go, hey, what are all these other expenses that you have here? They don't make any sense. And you go, oh, those are the travel that I push through, or those are I'm paying my spouse to do this, or my kids to do this. Okay, well, you want to add that back.
Let's zoom out a little bit. Well, actually, before we do that, I do want to talk about the broader M&A market, where you see things going. But before we do that, let's talk about, like, tax optimization. Is there a way to structure these deals so that it's better for the buyer and the seller from a tax perspective?
Yeah. Most of the time for a seller, obviously doing an entity or stock sale is going to be one of the best optimizations. The problem with that is most firms have been around for too long, so a buyer is not going to want to carry the liabilities of that business by buying the entity itself, and that's a reality for most firms. So The reality is most firms are going to sell, they're going to do an asset sale, which simply is they're going to be selling their customer lists, the rights to their employees, the rights to their vendors, and the brand name and the website, all that stuff. And then whatever computers or other physical assets might be in the office. And most of the purchase is going to be then applied to goodwill value. That's going to be the reality. So then that goodwill is going to be amortized over the tax life of goodwill. That's generally how most deals are going to get structured.
Tell me about like the best deal you've done so far. Like what worked about it? What did you like about it?
Right. So the best deal I've done is it was not in the deal structure itself, although I was able to find a firm that was local to me, and that was very, very helpful. And so I was able to meet with the owners in person. I was able to when I met the staff in person and be close to the reality of the firm and the transition, the changes. The other thing that was super helpful was giving the firm employees time, the selling firm employees time. So on my first purchase, we went way too fast on trying to transition the employees, and we tried to do that in a 90-day period, and it was way too fast. So we forgot to realize that the firm employees that we're buying, they had a day-to-day, they still had the day-to-day they had to run with their customers, but they also had to transition and onboard to our systems and get used to the way we did things. That takes a longer time than you realize, especially if you're doing it during tax season. So the second firm we purchased, we purchased it during tax season and then we waited till after the tax season was over to make any changes of transition over to our firm. And that helped a lot with client retention and employee retention.
That's interesting. Even though your firm is virtual and people work from home, it's still helpful to do an acquisition that is local because you can be there. You're not just a face on a screen. You can build the relationships. That adds a lot of comfort, I imagine.
Yeah, unless you're in you have the rare opportunity to buy a firm that's already virtual, which majority of firms are not. You're going to buy a firm with a brick and mortar presence, and likely they're leasing an office from the owner. I've seen a lot of firms.
Yeah.
Actually, every firm I've bought, the owner has owned the building. The accounting firm owners have owned the building that they're leasing from. So which is great for them, and it shows through the sophistication of accounting firm owners. They know how to maximize the value of their own cash flow. So they're paying themselves rent, which is great.
Yeah.
But the reality is there's a brick and mortar presence, and being around that brick and mortar presence just obviously gives you a lot of benefits in the transition of that firm to virtual.
As we wrap up here, let's zoom out a bit and talk about the evolution of the accounting M&A market. Where do you see things going? Is it going to get hotter? Are firm valuations going to increase? Are they going to decline as all the boomers desperately sell?
Yeah.
Who are left?
I think that there is going to be two routes for this market. One is there is going to be over the next 5 to 10 years, going to be a slew of firms, and the count of firms up for sale is going to only increase because the firm owners are all aging out and they're all getting tired and they're ready to sell their firms. So the number of firms that are going to market are going to increase, and the firms that are basically doing under 1 million, under 2 million in revenue, those valuations are going to go down because the market has so many of those firms. It makes up 90+% of the market is firms that are doing under 1 million, under 2 million in revenue. The firms that are above 2 million, above 3, above 4, and have have made these shifts of technology transformation and recurring revenue, those values are going to go up because the amount of buyers that want those firms are only going to increase. I've already seen it myself this year. This year, I've had more outreach from potential buyers than any other year so far. And in the first 3 months of this year, more outreach than all 12 months of last year.
These are folks who want to buy reconciled.
These are firms who either want to buy reconciled or get advice on how to buy a firm like reconciled, right? So I've seen more outreach than any other year so far. And so the number of buyers entering the market is at an all-time high, in my opinion. and the number of private equity groups looking for their first platform like Reconciled is at an all-time high. So I see the firms that are at a minimum revenue level of 2, 3, 4 million and up, their valuations are only going to go higher, especially the ones that have done the transformation already of technology and recurring revenue model.
So it sounds like now is the time to get started on moving to fixed fee recurring billing and modernizing your tech stack if you want to maximize the valuation of your firm when you go to sell in a few years. That's the way to do it.
Exactly.
Well, thank you everyone who has joined us live. This has been one of our most popular webinars so far, Michael, and I expect that the podcast version and the YouTube version will do just great, really valuable information. If people want to follow you online, keep abreast of what you're up to, where should they do that?
Yeah, look me up on LinkedIn or on Twitter. Easily to find my name, and I'm very active on both. So
wonderful. Michael, don't go anywhere. We got to wait for the local video and audio to upload. Thanks everyone for joining us. I'm going to play a video on how you can earn CPE. Don't forget, you can earn CPE for attending these webinars or listening to the podcast. Download the free Earmark app. And actually, big news, you can now use it on the web. We just completely re-platformed the app. So you can go to earmark.app. And in a few days, when this episode has been turned into a course, you can take the quiz and get your one free CPE. Thanks, everyone.
Congratulations,
see you around
Blake.
soon.
That's awesome.
Thank you, Michael. Today's webinar has ended. We hope you enjoyed it. To earn CPE for watching, download the free Earmark app. Scan the QR code on the screen to visit the download page. Open the app and create your account. Use a valid email address where you will receive CPE certificates. Then register for the course. You can search for it by tapping on the magnifying glass icon on the home screen and then entering the name of this webinar. If you're attending the live stream of this webinar, keep an eye out for an email letting you know when the quiz is available in the next few days. Pass the quiz to earn your CPE credits, then tap the button to email yourself a CPE certificate. Stay tuned for more webinars from Earmark. We appreciate you joining us today, and we look forward to seeing you again soon.